Something pretty big is happening with the US dollar. The bedrock of the global economy. It's been taking a serious nosedive. So, in this explainer, we're going to piece together the clues and figure out what's really driving this sudden and dramatic dive.
Our whole story really kicks off with this one number, 1.1920. So on January 27th, 2026, the euro hit a brand new long-term high against the US dollar. Now, for the folks who live and breathe the currency markets, this isn't just some number on a screen. It is a massive, flashing warning sign for the good old greenback.
So, what is going on here? The markets are flashing red all over the place. And over the next few minutes, we're going to put on our detective hats and piece together this puzzle of the dollar's big decline. All right, our first clue takes us right to where policy and politics collide. And what we're seeing is this kind of perfect storm of tensions brewing both at home and internationally, and it's putting a ton of pressure on the dollar's value. And look, this isn't just about one single thing. It's actually a pretty complex mix. You've got friction over international trade policy clashing with some pretty intense political conflicts happening right inside the US. And when you get those two things mixing together, well, that's when global investors start to get really, really nervous.
Yeah, it's a problem coming from a bunch of different directions. First, you've got all this trade uncertainty, with the White House announcing they're hiking tariffs on South Korea. At the exact same time, back in Washington, the threat of a government shutdown is hanging over everyone's heads because of a funding dispute. Then, you layer on top of that some social unrest happening in Minnesota, plus all these rumors swirling that central banks might step in. And bam, you've got a recipe for some serious market anxiety.
And you know what? You can actually measure that anxiety. The market probability of a US government shutdown, according to Polymarket, it has shot up to 78%. A number that high, well, it sends a pretty powerful signal of instability to the rest of the world. Okay, so with all this political risk in the air, how are investors reacting? Well, for our second clue, we just have to follow the money. And let me tell you, the trail is impossible to ignore. So investors, they are not waiting around to see how this all plays out. Nope. They are actively pulling huge sums of money out of US-based assets, and they're looking for safer places to park it. And the scale of this shift is just staggering. Just since the start of the year, those funds that focus on US assets, ETFs, they've seen $17 billion fly out the door. Meanwhile, ETFs focused on emerging markets, they've pulled in a record-breaking $134 billion. This is basically a massive vote of no confidence in the short-term stability of the US markets. But it's not just about money flowing out of US stocks. There's another really powerful force that's directly pushing the dollar's value down. It's a super popular strategy that goes by the name the carry trade. So, what on earth is a carry trade? Okay, in simple terms, think of it like this. Traders borrow money in a currency where interest rates are super low, like the US dollar is right now. And then they invest that money in a currency where the interest rates are much higher. Their profit? It's the difference between the two. And right now, this strategy is absolutely on fire. It yielded an incredible 18% return last year. But here's the crucial part. The very first step of this trade is borrowing US dollars, which means selling US dollars on the open market. And when you have thousands of traders all doing this at the same time, it creates this immense, constant downward pressure on the currency. So all this pressure on the dollar is creating some major ripple effects. I mean, think about it. When the world's main currency starts to look a little shaky, where do investors go? They run for safety. They run to what are called safe haven assets, investments that are supposed to hold their value when everything else is chaotic. And right now, their safe haven of choice is, you guessed it, gold. So as the dollar is falling, gold is doing the exact opposite. It is just smashing through records, surging past $5,200 an ounce for the first time in history. Investors are piling into it, just looking for a store of value that they feel they can trust. But what's really fascinating here is why they're all buying gold. Traditionally, it was seen as a way to protect against economic inflation. But now, the thinking has totally shifted. Analysts are literally calling it insurance against Donald Trump's policies, a direct hedge not against economic numbers, but against political and policy risk. Wild. Okay, so the clues from the market are crystal clear. Political risk is making money flee from the dollar and run into safe havens like gold. But what's the view from the White House itself? This is where the story takes a very, very sharp turn. On January 27th, the very same day the euro was hitting that new high, President Trump was asked if he thought the dollar had fallen too far. His answer was pretty direct. No, I think it's great. The
the value of the dollar's doing great.
And right there, you've got a huge contradiction. On one side, you have all this market data showing a currency that's really struggling. On the other, you have a message of strength coming straight from the president. So, what was the reality on that specific day?
Well, this heat map tells the whole story. See all those numbers? Each one shows how the US dollar did against another major world currency for that day, and every single one is negative. It's all red. So, on the day the president said the dollar was doing great, it was in fact the single worst performing major currency in the entire world.
So, to recap, on one hand, you have the market story. It's a story about investors reacting logically to risk, moving their money around to protect it, and hedging against all this policy uncertainty. It's a story being told with billions and billions of dollars.
And then on the other hand, you have the White House's narrative. This is a story all about projecting confidence, maybe trying to calm the markets, or just maintain a strong political image. The question is this a deliberate communication strategy, or is it a fundamental disconnect from the data that actually drives global finance?
And it all leads us to the really critical question, right? What happens when the actual machinery of the market and the public messaging from policymakers are pointing in completely opposite directions? This isn't just some academic debate. A weaker dollar affects everything, from the price you pay for imported stuff to how competitive U.S. companies are on the world stage. How this conflict gets resolved will decide the dollar's path forward, and with it, a big piece of the global economic future.